Welcome back to the channel, friends. Well, ARMs are making a comeback because fixed rates are high, people want options. And let's be honest, some of us plan to dump our mortgage before it ever even adjusts. It's savage, I know. Today I'm breaking down why ARMs are trending and whether they're a smart move or a financial booby trap. So fixed rate or adjustable rate mortgage, what's the difference? And which one actually makes more sense for you? The pros and cons of each and help you figure out which option can save you the most money in the long run. Let's go. Let's start with the fixed rate mortgage. This one's simple. Your interest rate and your monthly principal and interest payment stay exactly the same for the life of the loan. 15, 20, 30 years, we're locked in. It's predictable, no surprises, and if you like stability, budgeting long-term, and sleeping well at night, a fixed rate is very hard to beat. Now, the adjustable rate mortgage, or ARM, works a little differently. You'll usually get a lower rate up front, sometimes significantly lower, but that rate is only fixed for a set period, like 5, 7, or 10 years. After that, it adjusts, usually once a year based on the market. That can mean that your rate goes up or down. Here's a real-life example of the most popular adjustable rate mortgage, the 5-1 ARM. Is this the only ARM? No. You'll see 7, 10, all kinds of products. Typically, the longer it's fixed for, the higher that starting rate will be. I'm breaking this down in its simplest form. There are a few additional pieces, but it's beyond the scope of this video. So here's a quick example. Let's say you're buying a $500,000 home. On a 30-year fixed at 6.5%, that's $3,160 a month for principal and interest only. A 5-year ARM might get you 5.5% interest rate. That's $2,839 a month. That's over $321 a month in savings, or more than $19,000 over 5 years. If you're moving or refinancing before that ARM adjusts, you could come out way ahead. But if you stay past that adjustment period without refinancing, you could see your rate and payment go up. So it's important to plan ahead. So how does it work? Years 1 through 5, you'll pay that 5.5% interest rate, and it doesn't change. It's a sweet deal if rates are hovering around 6.5%. If rates never go up, you win, but that's the gamble. Now let's say that rates have gone up since you got the loan. Year 6 would be your first adjustment. With a 5-1 ARM, the 1 refers to how often your rate will change up or down beyond the 5th year, not by how much. This is the part we're not getting into. Depending on the product, there can be a built-in periodic and overall cap, but let's just assume that for as long as you own this home, every year your rate may change. But in this case, it's once a year. See how this can get a little unpredictable and at times make you feel a little uneasy? I get it. So let's walk through the quick pros and cons of fixed versus adjustable rate mortgages.
Best thing to do, pros and cons list.
A fixed rate mortgage, here are the pros. You have a locked-in rate and payment for as long as you want, typically a 30-year mortgage. It's easy to budget for, and you get long-term peace of mind. The cons of a fixed rate mortgage are that you have a higher starting rate compared to an ARM, and it might not be ideal if you're only planning to stay in the home for a short term. Here are the pros for an adjustable rate mortgage. You have a lower initial interest rate. That equals a lower initial monthly payment. This can save you money if you sell, refinance, or move before it adjusts. It's popular and often chosen by military families or anyone expecting life changes in the next 5 to 10 years. The cons of an adjustable rate mortgage are that the payment could increase after the initial period. You need a solid plan for what happens when the rate adjusts, and it's much less predictable if you're in the home for the long term. So which is better? Honestly, it always depends on your situation. And keep in mind, 3 to 5 years is a long time and plans can always change. If you plan to be in your home for the long term, 10, 15, 30 years, and you want consistency, go fixed. It's safe, steady, and you'll never worry about rising rates. But if you're only planning to keep the home for a few years, or you're in the military and expect a PCS, or you know that you'll refinance before the rate adjusts, an ARM actually might be the smarter financial move, especially if rates are well below the current market rate on the fixed side. So, as we've talked about, both fixed and ARM loans have their place. It's not about which loan is better overall, it's about which one is better for you. Not sure which direction to go? That's what I'm here for. I help buyers every day figure out the loan that fits their lifestyle. It's rarely one size fits all. So I hope that clears things up even just a little bit. There's a lot more to unpack with adjustable rate mortgages, but I wanted to keep it simple for you. Please reach out with any questions, drop a comment below, and don't forget to like and subscribe for more straightforward mortgage advice. I love what I do, and especially if I'm helping you. And that's a wrap. I'll see you on the next video.